Hey, what's going on, traders? Hope you guys are doing great today. This is Chris from Brillo Trading. I wanted to make a video talking about market context. I got a couple of friends asking me, how do I categorize supply and demand zones in the market? So I'm going to give you a couple of tips here when it comes to looking at market context, which means looking at charts. So how do I get some of these areas that give me a bit of context of areas that I should be watching for some potential two-way business, areas you should be watching as potential profit targets, basically areas you don't necessarily want to be in a trade. When the market gets to those areas, you might want to be getting out of a trade but not into one, because those are areas, or what I would call inflection points, areas where you don't necessarily know what is going to happen on the immediate test of it, and you do have an idea that this is an area where the market can potentially turn from. You can call them supply and demand zones, you can call them battle zones, you can call them support and resistance. I don't like those terms so much, but here we go, and we're going to explain in this video. If you enjoy this content, guys, don't forget to smash like and subscribe on the video. It really helps the YouTube channel, guys, so if you want to support the channel, do not forget to smash the like button. Here we go. Okay, so the first thing you need to know is what one-time framing is. One-time framing is a very simplistic concept that is used to filter out when the market is moving in one direction. At least that's how I would see it. So I'll try and give you an example of what it looks like on a chart first. So whenever you see bars that close in the same direction and market is moving in the same direction, that is what you call one-time framing. So you can see it a few times on this chart here. We're looking at 30-minute bars, and again, I just have to say, for context, I use 30-minute and 15-minute bars the most. Sometimes I'll zoom out, look at 2 hours as well, to the most of being a daily. When it comes to this one-time framing, supply and demand stuff, I only really use 30-minute, 15-minute. Okay, so here's an example of one-time framing. So the market catches a bit off of this low, and we start to move higher, 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 higher. So we have many bars in a row closing in the same direction. Now you can test the low of the previous bar, but as long as the bar closes up higher, then the pattern still remains as one-time framing. Now the first time we see a close below the low of a bar, in this case it would have been right here, that is where our one-time framing has officially ended, and that is now our new inflection point to be watching for potential defense when we get there the second time. You can see that the market, once it rallied back, that was the area where we sort of started to offer from, and we moved lower into there. Okay, so if you do look at these areas, you will notice that the market tends to respect them quite well. Again, you can't trade off of these areas only, because trading price, trust me, you're going to end up making subjective decisions. That's not the way you really want to be trading. And again, I can get into that in another video if you want, but this video is just simply for context purposes here. That's the basic concept. So one-time framing is when the market is moving up in the same direction, many bars in a row, or down in the same direction, many bars in a row. And you know, the simple idea behind that is you want to look at where the pattern ended, and that is essentially your demand zone or supply zone. Okay, so I'll try and give you an example right now. And you can see that in the last about 30 minutes, an hour of trading, we started to see a little bit of consolidation. So you can say, all right, I'm going to mark in that level where this bar closed below the low of this bar here. So that's going to give me an idea that this might be an area to be watching. Now Globex opens and the market shoots up, then starts moving lower. Again, we see a bar close below the low of the previous bar. And again, it doesn't mean that I'm a bear right away, but it does start to give me an area contextually here that I'm seeing as a supply zone. So as you can see, the market, it has moved down, and now when it comes back to test, this area is now offered, and it tested actually multiple times and was never able to hold it on the bid. That being said, if the market does move into this area and hold it on the bid, you definitely do not want to be short biased. That's a good way to lose money. Now in this case, this area is holding on the offer, therefore the bear bias still remains intact. And as you can see here, the market tries for this weak rally, and then we continue the pattern of each bar closing below the next, and this market is in fact moving lower. So that's what we call one-time framing to the downside. Obviously we see larger ranges during the cash market. So you can see this is where the market started to rally from. So that gives us an approximate area of what we would call a demand zone. This is where the market was demanded from. This is where the bulls initiated positioning into the market higher. Now, a lot of times I switch between 15 and 30 because there might not be a lot of clarity on one of them, so I'll look at the other one. So in this case, the 15-minute would tell me that the zone would start from about 217 until about 229 and a quarter, more or less. So this is an area to be watching as a potential demand zone. The market moves up, okay, fine. Now again, this is not relevant until the market actually comes back to test it. It came back to test it then later today. So we're going to continue going through this, and it will just show you how some of this stuff sort of works. So in this case, the market rallies up, and this is what we see here in the overnight session. So we have this area of supply, the market rallies through it, and now what we see is the market kind of consolidating yet again. So I wake up in the morning to this market right here, and I can see that we are below our supply zone. The market was previously demanded from this zone right here on a 15-minute chart. And again, maybe that profile is kind of blocking it, but this is where our bullish move started from. So I will categorize this 304.50 as a demand zone. And if I look at the 30-minute, I always look at both. You can also put the high of that zone as around 317 to about 320, more or less. We've gotten two levels that are close to each other that kind of give us our demand zone. Now, the market moves up to our supply zone. We traded above it and then held it on the offer. Now, again, on a 15-minute time frame, this market was bearish going into this morning. When the market opened, we saw a nice rally. Where did we rally to? Right to the low of our supply zone that we had marked in. So again, these levels give very good contextual areas. So for example, let's say you managed to catch a bid on this rally, you were long. Where do you want to be getting paid? Well, you want to be getting paid before the area that the market was last supplied from. Do you get what I'm saying here? Okay, so the market opens, we move down right to that demand zone I had just marked in from the overnight session, around 305 to 316. Now, when we traded there later in the afternoon, if you were watching the market, that was the key zone to be watching. 316 to 304 is on the offer and we're moving lower. There's a good chance we're going to take out the low of the day. If 305 is bid, I would not want to be short, in my opinion, because that is exactly where the market was last demanded from. So you kind of see how this stuff sort of plays in. So now, market moved down, now on the rally. Where did it rally to? Previous demand zone. What happened after that? It moved lower. But what happened at this area, this inflection area, was important in determining what would happen next in the market. We could have easily continued up higher, hold the bid, move higher, hold the bid, move higher, hold the bid, move higher, and close up in value. But instead, the bears defended it here. There was no one willing to bid this thing, and the thing flushed down, and now we're trading lower. So that's pretty much it, guys. I'll use this type of stuff on all three correlated markets just to get a good idea. For example, today on the Russell, it was very clear. If you looked at the overnight, you saw the market was demanded more or less from 226.7 to about 228.8. And the market did, in fact, see a big sweep down stop run, but then we held the bid pretty easily. Now, if you look at where the market was supplied from, right from about 237.9 to about 239-ish. Now, if you were watching the market today, you would have seen how well it was respecting these areas. Now, as the market is moving higher and holding the bid in this area, you really don't want to be looking to go short, because this is the last area here of defense for the sellers. If the sellers cannot control this area, well, there's no clear area above that that's going to hold the price down. You see what I'm getting at here? So in this case, we saw multiple stop runs, and then sooner or later, we saw the supply come back in. The way I see it, guys, it's all about fish in the water, right? The market will move up, test out the stops, come back in, slowly start offering lower. Now that people are trying to buy the pullback, there's fish in the water. Too many traders are long. What's going to happen? It's going to go down and test them out. Now traders are selling it. Okay, now it's bidding up higher, but people are still selling it, but it's bidding up higher. Guess what? There's fish in the water again. It goes up higher, takes their stops out. So that's how the market works. You want to give yourself a couple of tools to be on top of it contextually. So you can see finally we held this area on the resistance side, and then it finally rolled over. So the morning range more or less was demand from 226.7, supply up at 237 and 239 more or less, and that was the range we were playing in for a while here. And you can see how this area sort of gets respected pretty well, and on the retrace to almost pretty much to the tick here. You must remember that you cannot trade only off of these levels. They simply provide you with a contextual area to be watching, and a lot of times you will notice they coincide with high volume nodes from sessions. That's why I like to look at session profiles. because they can coincide with those things. For example, the market was demanded from here. You can see that it's close to the high volume node of this session. What normally happens is these areas, we tend to get flushed right through. Sometimes it bounces right off of it. Sometimes it'll flush right through and then bounce. You know, just a bit of context for you guys. Market context is very important, and you definitely need to be on top of your context. Again, I'll say it one more time. You cannot trade only off of these levels. And in fact, using levels like this to trade will get you in a lot of trouble, because you're going to be trading fixed prices instead of the prices that the market is actually trading. Guys, it took me a long time to learn this stuff, but all it takes for you is to learn how to read your depth of market. Forget all the levels on your chart. Look at your depth of market, look at the current traded bids and current traded offers, and look at the market and say, okay, the market was bid here, then it moved up, then it was offered here, then it moved down. It gives you an idea of where the market is actually trading and rotating from. Stop using areas on the chart to make your trading decisions. Use the areas on the chart as contextual areas to help you understand areas to be locking in profits, areas that could act as inflection points where the market could turn, and areas that are make it or break it to hold for the market for certain things to happen. Context is important. All right, guys, I wish you a fantastic evening. Take care. All the best. Ciao.